I'm Jessica Amir, a market analyst with Bell Direct. Well, there's no way to describe this financial year other than use an F word: floundering, faltering, and forgettable. Australia recorded its first negative quarter of growth in 9 years, down 0.3% from Jan to March. The unemployment rate rose to its highest level in 19 years, 7.1% in May. But the silver lining is that although the rate will peak in June, it's likely to flatten in July. Wages grew at their slowest pace in 2 years, up 2.1% year on year. The public sector has already frozen wages, and excess capacity is keeping wage growth flaky in the private sector. The Aussie dollar fluctuated from 70 US cents to a 17-year low of 55 in March, and then somewhat recovered to its current level of 69 cents. And we had record fiscal support from the Morrison government, while the RBA did its bit, cutting interest rates 4 times. The Aussie share market had a forgettable year, falling 12.5%. Recessionary shiners, healthcare and staples outperformed, up 26 and 7%. While on the other side, cyclicals like energy, financials and real estate dragged 34, 26 and 23%. The biggest anomaly when it comes to recessionary cycle investings was the tech sector, rising 13%. Now, looking to the future, we know the IMF tips the Aussie economy could fall 4.5% this year. So what does that mean for investing? Well, as we're officially entering a recessionary cycle, given the structural shifts and how sectors usually behave in contractionary phase, these sector trajectories are likely to continue. We know tech doesn't usually flourish in periods of negative GDP, but this time is different. Record low interest rates, bond yields, coupled with societal shifts and online behaviour are all trumping up for tech. So far, this has helped Afterpay, APT, find financial year first place, up 133%. On the flip side, free-to-air regional TV and radio business Southern Cross Media fell 80%, copping a COVID hit, with Unibol, Rodamco, Westfield, URW seeing additional selling after being smacked out of the ASX 100. Now, moving to strategy and ideas. Firstly, consider that tax loss selling comes to an end on Tuesday at 4 p.m. Many investors take this time of year to review their portfolios to crystallise a tax loss to offset against any crystallised capital gains over the financial year. It's also time for rebalancing, topping up those asset classes that have drifted from their long-term investment objectives and positioning portfolios for the turbulent times ahead. So review your portfolio's asset allocation, look for any tax offsetting opportunities and rebalance your portfolio back in line with your long-term goals. Secondly, something else to consider is the multi-trillion-dollar global government spending packages on infrastructure, loans and loan guarantees. The bars show stimulus announced in G20 countries as a percentage of GDP. The major developed economies saw debt-to-GDP ratios surge 24% just in 2 months. Now, if you compared that to the GFC, debt-to-GDP took 2 years to rise that much. So now the average debt level is at 152% of GDP. This is of concern. So consider that gold is seen as a store of wealth and rises in demand and value in uncertain times. So if equities do head south, having gold in your portfolio could offset the blow. And lastly, consider company confession season kicks off in July. We're really going to start to see how ASX listed companies have been impacted or not impacted by COVID-19. Remember, the first quarter results were not really telling as we only had 2 weeks of lockdowns. Company results to watch included Ampol, ALD, formerly Caltex, South 32, Woodside, CIMIC. The week after, Sydney Airports, SYD, BHP, Oil Search, Newcrest, NCM and STO Santos report, followed by Credit Corp, CCP, Fortescue FMG and Origin Energy. Now to trading ideas. Well, following the end of financial year selling, Mesoblast, MSB, one of the best financial year performers, for example, this week fell 22% to Thursday. The company's revenue has climbed 100% in 9 months. It's working on trials in heart failure and back pain, and MSB is also working on a COVID-19 cure. The company has got staff on board who've commercialised drugs with Novartis, which is one of the world's biggest healthcare companies. Now, Bell Potter backs MSB as a key stock, forecasting 60% share price growth. Now, historically, some of the most heavily sold down stocks in the financial year see a sharp rally in the first 3 weeks of July, so consider that as well. Morningstar tips Westfield URW as a fruitful recovery stock. This week, UBS reiterated or rated Mirvac MGR, Freedom Foods FNP and Parenti PRN as buys. UBS continues to see Telstra, TLS and Woolies as a buy. Bell Potter's new financial year picks were unveiled, including Macquarie, MQG, CBA, MyState, MYS in the financials. And in the diversified financials and fintechs, Bell Potter picks AMP, Afterpay and Life 360. In the retail and professional services sector, Temple & Webster, TPW, City Chic Collective, CCX and IPH. And lastly, if you're looking more closely at gold, then put your magnifying glass over gold companies like Newcrest Mining, NCM, which is backed by UBS and Citi, and Independence Group IGO, and Saracen SAR, also backed by UBS. Also look at GDX, MNRS, and PM Gold and QAU, all of which have already grown 30 to 67% in the past 12 months. On behalf of everyone here at Bell Direct, have a happy and safe weekend. I'm Jessica Amir. See you next week.